So, let's continue our journey in the field of risk management and finance by starting to study the trading in financial markets. If you are checking this chapter, it's much more like about derivatives markets. So at the beginning, yes, the book talks about that we have some markets and what is the function of clearing houses. But at the end of the day, we will see that it's mostly about different derivatives, both ordinary vanilla derivatives and also non-traditional derivatives. My personal problem was only with this that it defines so many things, and after that it starts with definition. But the reason is because in the later chapter it will talk about pricing in way more details. Just I was missing that which models can be used here, but at least the definitions are quite precise. So let's see that. Okay, what kind of reasons can we identify? Obviously, there are three kind of main motivations on capital market trading. One is arbitrage, when we are looking for some errors, some trading errors, and we are looking for some kind of risk-free return. But sometimes it can happen that we can think about an arbitrage, but it's much more like a speculation. So there is some kind of risk still. Or we can think about hedging. So we would like to trade away some of our own risk or some of our clients' risk. So that's why we are using hedging strategies. Or we are just operating or providing broker services. So we're just satisfying the needs of our clients. So we are not even speculating at all. Or maybe we have a speculative position because our client would like to have an option and we are underwriting the option. So we are issuing this option, and that's why we will be sitting on the other side of this option. And if we are not hedging this position, then we will still in some kind of speculative position. And obviously, the old-fashioned speculative thing is that we have an idea about how the market should operate, how prices should increase or decrease. We are thinking that something is overvalued or undervalued. So in this case, we are in this speculative position. And obviously, we have to consider the following issues. So how can we describe the instruments? This is what we are doing today. Mostly we are describing how they can be used during the trade operations, and also what kind of margins are set by exchanges as collaterals. Because in many cases, exchanges are always trying to manage partner risk by introducing clearing houses or other margin setting entities to remove the case that, okay, I created or I'm using derivatives, and suddenly the other side or other party on the other side of the derivative suddenly disappears because they went to default, and then also I'm finding myself from a hedge position suddenly in a speculative position. So that's why it's much better to use margins. Since the great financial crisis of the 1929, we have these solutions. And okay, if we are looking on markets, for some reasons we have two of them, but only one. So in the case of the markets, underlying market, that we can find two platforms. So one platform is the old-fashioned exchange trading, or this is the organized trade, and we can think about that which one is older, because we have exchanges only since the 1600s, and before of that and since then we can always find an over-the-counter market. So exchange traded is much more like a retail market with predefined contracts, with well-defined or standardized products, while at the same time customized wholesale market was always the over-the-counter OTC market, when you can customize all the components. So we can say that, okay, exchange traded in the past until the 90s. So for many centuries until the 90s, there were open outcry markets or trades where a small number of traders were on the market and they were able to see each other, and that's why interact with each other. However, since the late 80s, we can see that this human perspective started to disappear with the introduction of electronic trading. So it started in the 80s in the US, and sooner or later it disappeared everywhere until the end of the 90s. I remember on some papers where even heads or CEOs of different stock markets were arguing about that open outcry was much more efficient, because since bid or ask offers were not able to happen at the same time, because some traders or some investors were able to sleep, were not able to realize that prices are going up or down, then there were no chance for sudden fire sales. So the first famous fire sale related crisis happened in 1988, when there were so many stop loss requests built in on the New York Stock Exchange, that once it started to be executed, then prices went down immediately. So there was a sudden fall in prices, like the stock market was falling by 20% or more than 20%, and also the forward market, or sorry, futures market behind this in Chicago was also trying to catch up. But sooner or later, computers started to be overwhelming with the sales orders. They were not able to process everything in real time, so it melted down. So it was quite a disaster, and that was the first time when they realized that, yeah, synchronization of stop loss or other requests and bids can be a problem, because it can happen in electronic trading, it cannot happen in open outcry version. But whatever, nowadays we can see that stock markets and other exchanges are behaving much more like a server house, not a building or a facility anymore. They are just a server, or they were reduced to server, which provides different products and services, but still it's completely dematerialized itself. Okay, but still exchanges are defining their contracts, so there are a list of contracts which can be traded, and they are organizing the trading of these assets, and also they are defining the participants, who can be the participant on this market, and also they are trying to maintain the balance between the bid and offering prices, so the trade book. And the trade book is somewhat transparent, but sometimes it's not that transparent. So yes, we can at least have some lag to see the offers, because in many cases we can see that there are many bids in the book, but if they are unrealistic from pricing point of view, then the offers are not following them, so actually there is no trade. And that's why market makers were created to step in on both sides, and they remove this sudden jumps or distances between the bid and offer pricing. And It's a great deal because otherwise market would be way more scattered, way more volatile, so they are smoothing trade operations. That's the problem. It can be that, okay, market makers, maybe they can be forced to step in, so they have to be also secured. So yeah, they're supposed to compensate it for their positions. And we can see that this market spread can contain huge information. So usually under crisis time periods, when the market is not sure about prices, then the spread, the bid offer spread increases. Even I had a PhD student in the Hungarian National Bank who was analyzing bid offer spread on CDS markets and on bond markets, on sovereign bond markets. So yeah, this can be an interesting topic because it also describes the nature of volatility somehow. So okay, I'm always preferring to use lower frequency data, so analyzing daily or weekly currency markets. But if someone is focusing on high frequency data, then bid offer spread can be really important for them. So even right now, I was able to see some studies when they were analyzing or they were using neural network to forecast market data and to check them, and they were using tick data as an input. So practically each trade was done or included into market data or the analyzed data set. Okay, but there is also the over-the-counter OTC market, and in this case we can see a huge variety of assets because mostly whatever they want to be the subject of the trade, if they are able to find the counterparty of this business, then they can create a contract for this one. So this is completely the opposite of the absolutely specified and then standardized operations on the exchanges. In this case, you can customize what do you want to do. Even you can follow the exchange traded prices or conditions, just you can light them up a bit. So you can customize for yourself, for your client, and even you can use the exchange traded prices or spreads as a benchmark for your contract, but yeah, it is absolutely for the transactions between big financial institutions like banks, big corporations, so usually for multinational companies, and also for fund managers for large trades. And it's useful because exchange market or exchanges are much more about smaller clients. So this one is the retail market, this one is the wholesale market, which means that if all these businesses would flow in to the exchange, then it would increase the volume of the trade so much that it would break the market. So because we know that if volume is increasing, then the price impact is increasing as well for the individual trade. So if I'm starting to sell in huge quantities or buy huge quantities, then the price will react way more than if I'm doing it in smaller quantities. And that's why it's much better to separate this OTC markets, OTC deals from the ordinary exchanges. And in this case, the terms of contract will be up to the parties. And they can negotiate a mutually attractive deal, and they can be really happy with them. So to support all these operations, clearing houses were created. So they are doing all the administrations for the contracts on the market, and also they have their members. And the set of members is highly limited, so only for relevant financial institutions are usually participating, and then they are providing brokerage services for all the rest of their clients. And what is really important here, because clearing houses are not just administrating the contracts, but also they are trying to mitigate the partner risk. So that's why all future potential liabilities must be covered by collateral. It can be cash, it can be marketable securities, but there will be always some kind of a margin. And then during the entire presentation today, we will see that margin is reappearing again and again, because clearing houses have these regulations and rules to define what is happening with all this risk. So we can see that risk management, partner risk management, is done in many cases by the clearing houses on exchanges. And also we can see that central counterparties or CCPs, they are doing similar stuff on the OTC market. We cannot say that it has such a sophisticated system like in the case of the clearing houses, but we can say that it's close enough, so it has similar functions, at least in the level of maintaining credit worthiness. And practically we can say that if you are able to buy or operate a clearing house, this is a huge cash cow. So mostly you can collect all the fees for the administration, you can collect a lot of money on the maintenance of the margins, while at the same time, yes, it can happen that some parties are going to default, but still the margins will cover the losses in most of the cases. So these clearing houses are highly profitable. Okay, then there is also one issue to deal with, and we can see that we can have two kinds of positions: short position, long position. So in the case of long position, this is the most optimistic scenario, because in this case we are assuming that prices will go up. So I'm buying the asset, I'm keeping the asset, and hopefully prices will increase. And of course I can do it by purchasing the asset for cash, or I can do it by borrowing some components, so I can have some leverage in my position. So especially it happens during day trade, that some people are borrowing also assets and sitting on them, and they can use the asset as collateral. In this case, obviously you need this asset as a collateral, and also sometimes if the asset value starts to fall, then still some margins can be requested. So that's why day trade can be dangerous with high leverage, because even in long position you can suffer from this problem. In the case of the short contract, it means that if trader expects or investor expects that prices can fall, you can create a short position. In this case, first of all, you have to borrow shares from someone. Obviously, your financial service provider, so your bank or brokerage company, will provide this borrowing from another client who has already this asset, and then you can sell it immediately on the market in the usual way by selling it. And then you can wait until this contract ends. So it means that each short position has a predefined end. So sooner or later you have to buy it back, and it can be predefined by the brokerage company, by the bank, it can be defined by the investor, but sooner or later you have to close this down, and which means that the investor must purchase the asset and giving this back. This is usually placed on the account of the client, and obviously the profit will be realized that the stock price was has declined because we were selling it at higher price, we were buying at back at a lower price, so the difference will be our profit at the end of the day. Obviously the problem is when prices are going up during this procedure, and then we have to buy it back at a higher price, so that will be sad for us. Obviously there will be some small fee because still we have to remove it from another client's account, so the brokerage firm will ask for a fee since it's nice financial service. And also there will be a margin requirement, so margins are again coming back, so usually half of the value should be added. It means that 150% of the entire trade deal should be covered by a margin, and during the 2007 crisis, some markets, or before the 2007 crisis, some markets allowed these naked shorts, when actual brokerage companies were allowed to sell the asset without moving it between clients. And the problem was that, okay, you can do this, just later they realized that it can generate short positions way easier, and if the market runs out of possible buyback options, then yeah, it can create not nice situations on the market. So that's why sometimes they suspended it, sometimes they banned it. So if you are able to see that shorts are banned, usually it's naked short. It's old-fashioned short contracts are allowed in many cases. Also, what is really important here, that dividend and interest must be compensated for the client. So the client cannot see that his or her shares were borrowed to someone. So they still have to be compensated, which is quite important in this case. And we can have short and long positions in all the possibilities. So we will see that we have obviously in spot trade, but also in forward market, future market, options, swap, not in swaps. But we will see that this is highly general positioning. Okay, so let's see now the derivatives market, because until now we were focusing only on spot market in most of the cases. Derivatives are actually following spot market, so derivatives are much more like hedging against the fluctuation of spot prices. So we would like to mitigate our risk or manage our risk, or it can be a way more efficient way to speculate on the changes of this spot prices. So because, for example, options are really useful, that I don't have to take up a long position by buying all the assets, at least the desired assets on the market. I can say that, okay, I will buy a right to buy this asset at a, let's say, current price on the market, and if prices are going up, then I will execute my option. I will purchase the asset at this limited price, predefined price, at today's price, which is lower, then I will sell it immediately at higher price on the market, and then I have my profit. And in this case, I don't have to sit in this asset and wait for something to happen. So in many cases, derivatives are providing flexibility for the client. And also they can be exchange traded, or they can be OTC traded. And it's really funny because sometimes we can see that OTC market creates the derivative, and sooner or later it will be adopted by an exchange. And still, if we need some customized derivative, then we can get it on the OTC market. But we can see that since the 70s, Chicago Merchandise and oh my god, the other commodity market. So CMA and CBOA, so there are two markets in Chicago. Both of them started to focus on derivatives, and that's why we can see that okay, still OTC are way bigger because they are focusing on big clients. And what is really important here that we have to distinguish between the value of the contract and the underlying principle. Because I can buy and sell options or by paying the premium to have this contract, but the underlying assets can be way bigger because I can buy lots of shares. So that's why we have to distinguish. Okay, but first, before we are looking on any fancy OTC assets, then let's see first of all the plain vanilla derivatives. So they are the standard and commonly traded contracts which can be priced in easily, or at least with relative ease, and they are always considered as swaps, forwards, futures, options. So yeah, let's see this dandelion of plain vanilla contracts here. So let's start with forward. Forward is a traditional OTC contract, so it's still not adopted by exchanges because the adopted version of forward contracts, they are the futures. So that's the difference mainly. And what happens on forward market, that we have two companies, or maybe one is bank, but it doesn't matter. So we have two parties. One is taking a long position, so it says that I will buy the underlying asset on a certain specified future date. So specified asset, date, for a certain specified price. So it's like I can make it easily. So if I'm saying that, oh, I would like to pre-order a game on Steam, for example, and I'm looking on the price list, okay, it will be released within a year. It has a predefined date for the release, let's say Christmas or before Christmas. It has a predefined price because I see some nice euros there, and also it's a predefined asset, so I would like to purchase City Skylines, for example. I already have the game, but whatever. So in this case, I will have a forward contract without knowing of it. And in this case, the company which sells this game for me will be immediately in a short position because they will agree to sell this product for me under these parameters. And this is obligatory for both parties. So nobody can say that, oh, I don't want to do this because maybe prices are going down before Christmas, there will be autumn sale or something like this. Okay, maybe on Steam I can do this, but on forward markets I cannot step down. If I find someone who will purchase my position, then I can do this. But otherwise, we can't leave from this derivative and keeping one leg empty. And also we can think about by using it for hedging. So originally forward contracts were like for farmers, that I'm growing my grain, so I put the seed in the ground right now in March, and I don't want to run any kind of risk here. So maybe the weather will be good, then I will have a nice harvest, maybe the weather will be bad, and still I have some kind of harvest, but maybe if I'm still lucky and I have a good harvest, but the market is flooded by grain, then the prices can go down, so it will be problems for me. So in this case, it's much better to say that, okay, let's define a nice quantity of grain, what I can sell, a potential output of the farm. Maybe not the entire, because still the volume of the output can fluctuate, but unexpected output can be sold away through a forward contract, because I know that in July there will be the harvest, and immediately I can sell it on the market at a quantity. And maybe if I have a surplus, then I will sell it on the spot market immediately, or I will store it in some reserves or storage facilities, warehouses, and then later on I can sell it. But at least I have a defined buyer, let's say mill at this time. So, and in this case it can happen that, let's say we are talking about not grain but British pounds, and the payoff for a British pound will be different foreign exchange rates with quantities. And also we can think about that, yes, but also interest rates can be added, because if you are sitting on a money, then sooner or later interest rate will be also a factor. So that's why in the case of forward contracts, sooner or later will we see forward interest rates as well. So it will be funny to see. Okay, but now also let's compare all these positions with the futures. And the futures are always traded on exchanges, and they are always following each other in pricing. So they have similar prices, but on future markets, settlement is daily. So if you are going there, you can have daily data. In the case of forward contract, they can be settled only at maturity. So you cannot move out from the position. In this case, on exchange, on futures, you can sell it anytime, because you have at least a daily settling data. Okay, if we are looking on the Hungarian market, sometimes there is no trade in some futures. So the daily settlement can be illusion sometimes if the market is not deep enough in the product, but if you are going to Chicago, I think that we can have this one. And in the case of futures, so the benefit is that it's really easy to close down a long position, because we have just to sell the same contract. So we don't have to wait for final delivery. In the case of forwards, in many cases there is physical delivery, or it's up to the contract, but in many cases the custom is that they are doing final delivery. In the case of futures, usually they are focusing only on cash, so they are closing it out before the delivery mode is reached. In some trades, in some exchanges, they can also request, even for futures, that physical delivery must be done. So it can be a problem if some investors are sleeping over, or maybe a bank is sleeping over, or someone who is doing the trade. Because in this case you have to purchase the grain and deliver the grain, or cows or oil, and yeah, it can be problems. And also future and forward markets, I mentioned already grain and cattle already, but they are highly related to commodity markets, because you cannot sell and buy immediately huge quantities of crude oil, for example, or huge quantities of grain, because it's not easy to deliver such instruments. And later on, after the 70s, also foreign exchange, so currencies, became highly popular, since the introduction of free-floating exchange rate happened during the 70s after the fall of the Bretton Woods system. They started to become or operate there as a tool of hedging of exchange rate risk. And still we can see that, okay, we can find it also on the stock market, but in the stock market, spot positions can be much more obvious, because you can physically giving the shares immediately. We can imagine it, not like giving several millions barrels of crude oil. Okay, and also if you are checking the contracts, you can see that even for grain or for oil, there are already predefined qualities. So, or for example, orange juice, you can also find it that it's highly standardized. That in case of crude oil, the sulfur content, the gravity of the oil. So that's why we have these brands and BTI and Ural type of oils, because they can be processed by completely different refinery and technology. So that's why we have to standardize in this way. Also, clearinghouses, really important here. So clearinghouse will defend all the clients against the disappearance of one or the other leg here. So they have to create an initial margin to protect against default, and then this initial margin must be corrected by the changes of the prices. So there is this variation margin which can go up and down following the price. My problem with the entire future market, and that's why I don't like to participate personally as an investor, that the definition of the margins are highly non-transparent. So we can say that, okay, margins are increasing if the volatility increases. But you cannot see, there is no equation or function which describes you that margin is increasing because of this and that variables. Just the clearinghouse says that you need more money to put on your account. And this can be a problem if the market starts to dry up. Because in many cases, the correction of the margins, especially if is made by big banks, so it's not small retail clients like me, but for big participants, an increase in the volatility can result that you have to increase your margin by hundreds of millions of US dollars, like it happened in the case of long-term capital management. And if they are not able to take up such amount of loan to maintain their margin call, then their entire position will be liquidated, or at least some part of it, until the clearinghouse thinks that now the position is sufficient enough and the risk is sufficiently low enough. So that's why you have to be really careful about margin, because margins can change and their size can grow related somehow to the volatility. And that's why banks will ask also for maintenance margin. So if you are using any kind of brokerage service to operate on stock market or on futures market, then the maintenance margin will be asked as well. And also you can check also the contract, but usually it's not completely defined how margin are requested. So okay, let's see swap contract. So swap contracts can be based on interest rates. Unfortunately, interest rate swaps are only introduced in the book yet, but in later chapters there will be also currency swaps as well, because currency swaps are really good if you need liquidity in different currencies. So let's say that I'm the German company, but I would like to have an investment in the US, so that's why I need US dollars. It would be obvious to take up US dollar loan, but no German banks would like to do this for me because they don't have US dollar deposits, and that's why they will not provide me loans in US dollars. And also it would be really hard for me to go to the US and without any credit history to take up a loan there. It would be much more expensive. So it's much better to take up a loan in euro and look for a US company which is in the opposite position, so that they need euro liquidity, and then they will take up a loan the same amount of principal in US dollar, and then we will provide a loan to each other in our own currency, and then we will indebt it towards each other in the same amount of principal but in two different currencies, and then we will start to pay back each other's loan, and we will be happy because now I have my US dollars and the other company will have their euros. Similar thing is happening in the case of an interest rate swap, because in this case company B is able to take up a loan in a floating interest rate, while company is able to take up a loan in fixed interest rate, and after that they are saying that okay, but I prefer much more to have all my interest payments fixed as possible. They don't want to run interest rate at all, while the other says that oh, I can take the floating risk because I'm expecting that interest rates are going down, so for my best interest is to have this. But for some reasons the banks are saying that no, you can have only fixed rate, now you can have only floating rate. So they are settling down with each other, and usually in this case an investment bank helps this process to meet each other, and then they start to exchange. So again, lending, the principal amount is completely the same. The difference is only in the case of fixed and floating rates. And if they are doing it efficiently, so if the investment bank is doing its job well, then sometimes they can even save some interest payment. So this is the profit for the investment bank at the end of the day. When we will pricing in swap agreements, we will see, and this can be really ugly. So I think that this is the most disgusting kind of derivative in the market, because you have to describe the entire present value for company A and also for company B to define the position of their or the present value of their entire position and all the exchanges of the cash flows, and after running several lines in Excel or in MATLAB, then you can have it finally. Especially the problem is when one loan is paid on monthly level, the other is semi-annual loan, so still you have to compensate for everything. So yeah, this will be hard to model, but it's an interesting market, and for example Morgan Stanley has an entire division for that. So several years ago one of my friends was also hired there, and he's still doing this. So we can say that swaps are really important. Just in this case you need always a counterparty. So it's really hard to find someone who desires the right thing, and yes, we can say that artificially, if a bank is good enough, then they can replicate company A or company B by purchasing the right portfolio of bonds, but it can be really tricky. So it's always a customized market. That's why it's only existing on OTC basis, not on exchange. Okay, but let's move forward, because we have options, and options started to exist on the OTC market, and it was quite a small segment of the OTC market. So it has low profitability until the 70s, but once Bretton Woods system started to collapse, and companies immediately needed some kind of way to hedge their currency exposures, this market emerged. So all these pricing schemes, how can you define different option fees, emerged during the 70s. So mostly we can say that the entire capital or corporate finance, so all the CAPM model, all the Black Scholes and modeling and efficient market hypothesis was the result partially of the born and emergence of the options market, mostly because the same people contributed to everything. So if we are looking on the names, we can find that it was the same guys. And in the case of options market, it's really good because while in the case of futures or forward markets, both parties are obliged to do this long position and also to do the short position. In the case of options, one counterparty can step back. So there is always someone who will write out the options, so we'll provide or sell, we sell the right to buy the underlying asset by a certain date and a certain price, so let's look here. But in this case, this right is sold for a premium. So, which means that, okay, if I'm writing out this option, I cannot step back. So I cannot say that, no, I get your money, I was taking your money several weeks ago, but no, I don't want to deal with you anymore. No, but the other party who was paying for the option, they can say that I don't want to execute the option because now prices are going up. And in this case, we can say that there is a call and there is a put option. So call option is right to buy, put option is right to sell. So if we are imagining an exporting company and all your export revenues are coming in euros and all your expenditures are realized in, let's say, Polish zloty. And obviously, your profit in zloty, if you are a Polish company, can increase if the zloty depreciates against the euro, because in this case we can say that these euros will worth more and more zlotys if we are converting them down. The problem is what happens if zlotys start to appreciate against the euro. Then in this case it's much better to say that, okay, let's purchase a call option and I will have the right to buy zlotys for euros, and I have the contract right now from my client, or I can assume that what will be my position 1 year later, and in this case I can hedge out this risk or some of this risk. So all the topics of currency exposure management sooner or later ends here with call and put options. And why I like options, that in this case we can make the entire exposure explicit. So we can see that, okay, what happens if we are taking this risk? We know that how many euros we have to convert to zlotys, then how many, we know immediately that, okay, such amount of options we have to purchase. And then let's take a black source, or in this case a Garman-Kohlhagen, but it's a black source equation, kind of equation. Option pricing fee, we are adding the necessary inputs, so the volatility, the interest rate differential between the euro and the Polish zloty, and then we have an assumed price for this option, and it makes the entire position explicit. So it is nice, and we can see that it's transparent, because option fees are always fluctuating around this theoretical fees. Okay, it can go up and down, it depends on supply and demand for options, obviously, and other fractions on the market, or frictions, sorry, on the market, but still, at least it can be estimated, and we don't have such margins like it happens on the futures market. So that's why I prefer them. Okay, and some naming. So we have a date, an expiration date or maturity date. We have to define it, and the exercising. So when we can execute the option. So in this case, it means that not executing is exercised, but the meaning is the same, just synonym. European options are way simpler to model because they have an expiration date. So we know that this is a 1 year option, then 1 year later we have this chance to buy or to sell the asset. We can say that, oh, I don't want to do this because now my prices are operating completely well. American options can be exercised at any time until the expiration date. So that's why we can model them, but it's way harder. If we are a mathematician, if we are an economist, then we are using a different pricing method or pricing model. So we are using a different function in MATLAB, for example. So it's no problem for us, but to understand the mathematical background, American options are way harder to process. And also we have to consider several issues. So first of all, we have to distinguish between the at the money, out of the money, and in the money positions. So at the money, we can say that when the strike price is the price of the underlying asset and they are equal. So in many cases that I want to hedge. Right now I know all my positions as a company or as an investor in my book, and I would like to maintain status quo. So in this case I will set all my position at money. So strike price will be immediately the same like the price today. But obviously prices can diverge from this case, so we can be out of money position when the strike price is higher than the price for call contract. It can be a problem because in a call contract we would like to buy something, and if knowing that sooner or later we have to sell it, and if prices are lower, spot prices are lower than this one, so we are not able to reach profit in this case. So in this case, call option will be useless. However, the same thing is happening for put options, just in a different direction. So out of money and in the money positions are like that. This one is useless, this one is useful. It's nicely phrased version of them. And yeah, also option fee is named as or called as option premium, and also in many cases exchanges are requesting also margins. On short-term option you don't have to have this, but if it's long-term, so it means that it's longer than 3 months, then you need to have 75% initial and the maintenance margin. So you have to prove them that you are able to buy these shares or currencies, so you have to keep it on the account. So still we can say that okay, in practice, in theory we don't need margins for that to having options, but in practice still we can request for it. But it's not a big deal because in real life still you need some kind of position to execute the call or put options, and also it secures the other party because they can say that you are able to execute. But if you are writing out an option, so you are selling the options, you are collecting the nice premiums, it means that you have to have the value plus 20% of the share price minus the out of money position, or the call or put position has to be covered. So it depends on the market. The book suggests that both can happen, but they were not providing any more precise background for it. So, and it can be reduced if the trader has other position in the stock. So if you have already the shares in the background, then you don't have to do any of this. But if you have only cash, then you have to prove that you have some kind of position here. Yeah, and we have a last thing, because we have this interest rate options on the OTC market. Because if we can have swap agreement, if we can have options, why not to combine them? So we can have caps, floors, and swaptions. So caps are providing upper limits for the floating interest rate, and you can say that okay, if we are going above this level, then there will be a payoff. So it actually limits yourself against interest rate risk. Again, just you don't have to have this fancy swap agreement. You can go on the OTC market and you can say that okay, maybe there is an inflation shock right now, what is happening. So if we are going on the market in many places, then we can see that there is an increase in the level of interest rate because of the inflation premium, but we can expect that sooner or later disappears. So why not to secure ourselves against it, so we can cap it. But the opposite can happen, that we have a floor option, so we don't want to have a sudden fall in the interest rate. Like when we are, for example, an investor. So in this case, it's much better for the debtor. In this case, it's much better for the lender to have such hedging position. Swaption is an option to enter into a swap agreement at some future time where the fixed rate is the strike rate. It's also nice because let's say that right now I'm taking up a long-term mortgage at fixed interest rate for 25 years. And in this time, for the bank, it's much more, let's say, rational to purchase a swaption at the same time, because if they are able to see that there is level of disturbance on the market, then they can initiate this option, and immediately they can find themselves in a swap position, and they can mitigate the risk. However, also we can say that LIBOR is sometimes mentioned as a synonym of floating interest rate, and in the past it was valid. So the London interbank market interest rate was defined by the banks for overnight, for 1 week, 1 day, 1 week, 2 weeks, 3 months, and so on until 10, 12 months level, so until 1 year. But the problem was, and there was a scandal also in 2008 and later on, that it was not a real data collection. So LIBOR data was based on a query. So the query was sent out to the main banks on the London interbank market, and they were asked that, okay, please define that what would be the potential interest rate for one day deal, for an overnight deal, for a 1 year deal for another bank under strict specifications. And then they were collecting these responses, and then they removed the extremities, and then what remained there, that was the LIBOR interest rate. And okay, in the past, when there was no internet and there was no data about electronic trading, but it was everything done by humans and maybe on phone, it was working efficiently, because the central bank had to send this out in the morning and maybe in the afternoon, and they had some LIBOR data, and then it could be used for swap agreements and for other floating rate businesses. But the problem is that if banks are starting to operate in a cartel, then they can increase LIBOR rates or even decrease LIBOR rates. It's up to them, because nobody is forcing them to provide loan exactly at this interest rate, and that was a great problem. So nowadays we can say that LIBOR is abandoned in this sphere globally. So new risk-free benchmarks were introduced everywhere. So if we are looking on the USA, the UK, Eurozone, Switzerland, and Japan, we can see that these new benchmarks were introduced, and we can see that mostly, okay, except the Swiss case, because here the Swiss exchange is supervising the data, but all the other cases central banks are supervising these benchmarks. And we can see that in all the cases they are looking for actual market data, so actual average of contracts done on the market. Okay, depends on that. Sometimes it's treasury bill covered repo, sometimes it's actual interbank market lending, sometimes they are defining thresholds, so it has to be on the wholesale market above 1 million euros. It can be deposit, it can be lending. But we can see that some kind of weighted average of real market, interbank market, and or banks interest rate what we are using. So LIBOR now is disappearing. We can find it mostly in the textbook, but please remember that now LIBOR days are over. So they are expiring. We can find many papers which are using this, but sooner or later, if we are looking on 1 decade later on this market, we will not find it anymore. Maybe they will renew this, and there will be a new product for LIBOR, but it will be not the same anymore. Okay, but now let's move towards non-traditional derivatives. So what is happening when we are using not this plain vanilla contracts, but other approaches, other derivatives? So we can see here weather derivatives, oil derivatives, natural gas, and electricity. And my problem is that practically, if we are looking on forward future markets, we can see that, oh come on, oil and natural gas, they are there. So I don't know why they were distinguishing among them. Maybe because if you are reading the book, then they were writing some nice subsections about this product, but yeah, but technically they are completely old-fashioned future products. So I don't know why we have to distinguish them. So let's see. First of all, weather derivatives. It's fancy, and it will be even more fancier because nowadays you can see that green finance is became now it's trendy to have ESG rating on everything, and you can see here weather derivatives because mostly central banks are afraid of climate change because of two things. One is the exact harm of climate change. So climate change is maybe a wrong approach because we can see that climate became much more volatile, and volatility obviously is bad for business. So to reduce this kind of volatility and the harm of the volatility ability to trade away the volatility, it can be much better for the enterprises. But also, so this is just one part of the issues. The other is that it can have a transitional shock for the market. So some industries will disappear, some industries will appear and will start to bloom, but this transition can cost also money and can bias investments, can bias returns, can have an influence on bond markets, ratings, and so on. And that's why they are introducing these ESG scorings for all these banks, shares, portfolios, and so on. That they want to distinguish amongst the different assets. And but to mitigate this exposure, so focusing back on the first part, we can have these weather derivatives, and they are quite old because in specific industries you need heating, and you need maybe not just heating. So we have greenhouse, but also I know that in Georgia there is excellent wine. I heard great rumors about it, and maybe I just tasting once or twice, but yeah. So they are really good wines. And you know that grape requires at least some kind of positive temperature when it's growing, and that's why you need some smoking and other ways to avoid freezing mornings and nights, and as a result it can generate costs. So we can see that there are this HDD, so heating degree days contracts, which is defined that, okay, volume of energy required for heating during the day. And unfortunately, everything is defined in Fahrenheit because of Anglo-Saxon issues. So we can see that the differential between 65 Fahrenheit and the average of highest and lowest temperature during the day at a specific place. So in this case, they are defining a weather station, and this weather station will provide transparent and reliable data, and then the contract will be based on this thing, and they are looking for the differences, and this will define the HDD, and on this base they can create forward contract, option contract, which will provide the payoff by the cumulative monthly HDD or CDD, and sometimes it has a payment cap. At least in this case, people under agriculture can hedge themselves. The problem is that mostly it's on OTC markets. Only the CME has some kind of hurricane frost for futures and options. So I think that this is the part where central banks could influence positively the markets by forcing stock market or by forcing future markets and exchanges to have such products. Because if we are not just want to talk about green monetary policy, then we should have also greenish, at least green-related derivatives as well, and this is one of such derivatives. Okay, if we are focusing on non-green, much more like brownish assets, so oil derivatives are special because in many cases there are fixed price contracts, and in many cases we can say that, yeah, so if you are extracting oil, it's obvious that you want to have a secure position, because you need a huge amount of capital to build up this infrastructure, to build up the oil well. Maybe you need some pipeline, but maybe if you need have some tankers still, it requires huge investment. So, but also at the same time, market demand and supply fluctuate, so it can drive also prices. So there has to be some exchange between a fixed price and at least future prices, and also in many cases we can see that, oh my god, oil prices are going up and down, but it's actually a construct based on so they are generating artificially spot prices based on the existing or already existing future positions. And still, if you are saying that, oh my god, oil prices are going up, most of the oil sector will be not affected immediately, because they are sitting in a forward or futures position, or maybe in options. So yeah, for day traders or who are wanting to step on the market, it can be important. But if someone is careful enough and they are able to cover all their positions by using forward or future contracts, then for them it can be profitable if oil prices are going up, because they can sell their already existing hedge positions, on the futures market, but otherwise they can be completely unaffected. But also we can see that the different oils are not compatible to each other, so we have different sulfur content, gravity, so that's why we have the Brent, they are the West Texas. Actually there are way more, so there is also in the Gulf countries, there is also something in Indonesia, there is also different, so there is Ural, the Russian oil, so there is way more, just the book is not mentioning that. And also there is trade not just in crude oil, but also gasoline, heating oil, fuel oil, heating, right? Sorry for that, gasoline and kerosene. So we can purchase also this product, and that's why it's funny, but we can have trade for refinery margins, because if we are looking on that, okay, all of them are the product of refining process. So if we are looking on the spread between the crude oil and the regional refineries, it can have also it can provide information about the owner oil company's share price, because in many cases, so if you are having an oil company and it imports the oil and refines it and then sells it on the market, mostly what you are living off is the refinery margin. so that's why if we are looking on this data, then we can reconstruct that what is happening or what can possibly happen with the share price of this company. And of course, there are two main markets. One is CME and the other is ICE. CME is mostly for the US market, ICE is for the European market, and there you can have swaps, forward contracts, options, and especially on these markets we can have futures and options. Natural gas is a bit different because it has higher seasonality, but yeah, the book says that it's used on winter mostly. Yes, but at the same time, natural gas is also used as a primary input for what is the name? For artificial fertilizer. Yes, artificial fertilizer production. So, and that's why natural gas prices can have indirect influence even on agricultural prices. So not just because some tractors are using oil, but also because fertilizers are main products. And also we can see that petrochemical industry can have also this oil and natural gas exposure. So it's not just for heating or electricity generation, which is sometimes confused. And in this case, still we have to move the natural gas through some kind of pipeline. And okay, we can say that oil is different. Oil is not different from natural gas. So why we have to talk about them? Because one significant difference is that you have to keep natural gas pressurized. If it's running away, then it can explode easily. And also, since you can keep it pressurized, if you are increasing the pressure, obviously the temperature goes down. So you have to insulate it somehow, because if it's not insulated, then it starts to boil off, so it starts to expand and it will rupture the container and it will explode again. So that's why natural gas requires way more careful-ish operations than oil. Oil, it can spill out, it can pollute the entire environment, but it's way harder to explode than natural gas. Mostly, if oil starts to burn, then the gas is coming out from the oil, so not the liquid. The liquid is okay. Still, we can in engines we can see that okay, we can burn it, but the ignition is way harder to achieve than in gaseous form. So that's why natural gas market is way more dependent of the gas lines, or you have to build huge liquefying plants. Then you can compress it down to high pressures, and then you can move them around. For example, Barcelona, if you are going there, there is an excellent castle with really good view, and on the side of it you can see the sea, but on the other side of this castle you can see also huge liquefied natural gas terminal with huge ships and huge storage facilities, so it's a nice place to settle down and watch some logistics as an economist. Okay, and let's see electricity. Electricity is special because it cannot be stored easily. Okay, if we are Elon Musk and we have nice power walls or other accumulators, we can say that okay, with batteries we can do this. Or if we are building huge water dams and we are pumping water in or letting the water out, then still we can store it somehow. But mostly the entire grid is we don't have, unfortunately, storing capabilities, which is a great problem because if demand increases, you have to increase the capacity, the power generating capacity immediately. So you have to turn on generators, you have to burn way more coal or natural gas immediately. If you are not able to do so, then the hertz and also the voltage start to decline, and then your system will fail, or at least the electric products are not able to operate anymore. There is some tolerance plan, but sooner or later you are not able to achieve it. Or, for example, if we have lots of wind energy or solar energy, it can happen that you have to turn off different power plants, different turbines, because now you don't need such amount of electricity. So right now, still the biggest problem of renewables are, on one hand, they're really low load factor, so we have to build up huge capacities, and only 10% will be actually added to the grid in most of the cases. So that's the problem of low load factor. And the other thing is their volatile contribution to the grid, so that's why you have to balance it out with other fossil fuel power plants or with huge batteries. It depends on the investment and the structure of the grid. And in many cases you can sell the excessive power through the grid to other areas. In the US also they have this, in the European Union also we have this ability. The problem is always that it's nice to talk about it, but usually nobody invests into cross-regional power lines or transmission lines, and that's why sometimes we can see really terrible things when one part of the region is absolutely overproduced by electricity, and they are not able to get rid of the excessive electricity because of the infrastructure is not well developed, even in Germany. So in many cases, when renewables are working fine in Germany, they are trying desperately to sell this electricity on the spot market to Poland, to Czechia, to anyone who buys it. So that's the problem, that there is a huge incentive towards constructing renewables, but not for storing or transmitting this one. So it's, and it's not just in Europe, it's also in the US. So it's a regulation error, and then it's not just related to renewables, but mostly it's the problem for the state. Yeah, and in the case of the CME group, we can have also future contracts for electricity. Also, there can be OTC contracts, so that's why we can buy and sell this kind of products. And A typical contract looks like this, that one side will receive a specified number of megawatt hours for a specified price and a specified location during a particular month. So you can purchase yourself a contract for supplying the company, or maybe you are locating in a different location, but still you can hedge out the risk of spot price changes. So it can be used also for hedging purposes. And there can be swing options or take and pay options. So it means that you can define maximum or minimum for the amount of power that must be purchased, and the holder can change or swing the rate of which the power is purchased during the month with limited number of changes. So that will provide some flexibility for us. And still there are some exotic options as well. So Asian options are like the payoff is based on the average of the price. It's funny because it's not focusing on price at the end of the contract like it's happening in the European option, or it's not focusing on all the possible prices like in the case of the American option. In the case of Asian option, they are focusing on the average. Or they can have a basket option, so they are focusing on portfolio of assets. I think it's quite obvious. Also, they can have barrier options. In this case, there is a certain barrier. So, in the past, I had an investment fund which was providing profit only in case of the Hungarian forint is not depreciating under some level. So what means that there was a barrier option behind this investment fund. I liked it, but sooner or later I sold it because usually you don't want to sit in such an option for too long. Also there are binary options, so it means that there is a fixed dollar payoff or at least some certain amount will be provided if some condition is satisfied. So it pays or not pays. But the conditions are defined externally. So it not depends on because in usual options, the payoff depends on the price. In this case, some external conditions will be determined. So that's why it's special. But it can be look-back option. It means that they are looking on the entire period, and if they are reaching a maximum or a minimum price, or it can happen also that they are standing in between, then they will be doing the payoff. Practically with look-back option, you can create it with a nice combination of put and call options, and you can create an artificial fixed exchange rate for the company if you want it. So you can avoid volatility or reduce volatility. Also, structured products. It means that there are way more structured products. I don't know why the book was not focusing so much on this topic, but it means that you have some kind of bond, and this bond only pay some profit or return if conditions are satisfied. So it means that actually in practice that you are paying in the capital, the principal, and this part of this money will be invested into some options. The other part of this money will be invested into fixed interest assets. So let's say they are putting it a bank deposit, they are purchasing treasury bills. So something like where the risk is really low and you can expect or define well the interest revenues. And when the bond expires, then this fixed interest asset will generate the entire capital. So you are not able to lose actually the capital, the original investment in this bond, but the entire profit above this will depend on the option. And if the option is not performing well, then you don't get anything, at least you get back your capital. But also there are cases when they are still generating some kind of profit. It means that they are purchasing less or lower amount of options and they are purchasing more fixed interest assets. So practically they are reducing the probability of higher gains. And this is how structured products working. In Hungary, it was called as guaranteed investment fund or guaranteed mutual fund, and after that it was renamed like principal secured investment. But mostly we are finding in the library as structured product or principal protected note. Unfortunately, I like this asset so much. So this was my first investment as an investor in 2005 when I stepped in the commodity market with my initial capital, and it was really good because you were able to look on the different principal protected notes, and you were looking on their investment strategies. You were able to select that, okay, let's purchase this one, that one, and maybe they were working or maybe they were not working, but still in a low inflation environment, this is not a great risk because still I'm losing inflation but not losing capital. The problem is that since interest rates became really low during the 2010s, mostly it killed the principal protected note market. So once they had a 25% share from the Hungarian market, now it's maybe zero. Maybe they will come back if interest rates are back again. So as an investor, I like that so much. But even my first article, scientific article, was about principal protected notes. Yeah, this just started my career. Okay, and last thing, there can be risk management challenges. So mostly I mentioned that I started literally the presentation with these different motivations behind using derivatives or stepping on the market to use different assets. The problem is that sometimes we can confuse our positions. So sometimes it can happen that we are thinking that we are doing hedging and practically we are doing speculation. Mostly if we are mispricing an asset, and it can be highly disastrous. So mostly banks are trying to avoid this by creating risk limits, by creating trader monitoring, and then they are implementing several controls to ensure that derivatives are being used for their intended purposes. But the textbook has really nice examples when this did not happen, and at the end of the day, some hedge funds and some banks had to lose a lot of money. So we have to be really careful that what we are doing here and what is the intention and the reality. Okay, so that was all about the lecture, and I was highly efficient in time management, so it's exactly 1.5 hours.